Welcome. Good day to Explore Protect YouTube channel. It's your host here, Dr. Meiya at the Money Magnet. Welcome. If you are new, we welcome you here. Subscribe to this channel and set on your notifications so that you're informed each time there's a new video. We are here doing the last of this 6 series valuation models. We've been talking about business valuations. We have said that understanding valuation is both the science and art. We've gone through this before. The science using measures, estimates, and modeling capability, and the art revolving around experience, exposure, practice, and knowledge. And today, we're doing the 6th valuation model, the liquidation model. We've done the market cap times revenue, earnings multiplier, discounted cash flow, and the last video was on book value. Today we're doing the valuation, a liquidation model. Again, straightforward, not complicated. Really, the liquidation is when you look at the net value of the physical asset of the entity when it has to put loosely to go out of business. What is important when you're working out the liquidation valuation is that we do not include the intangible assets that include your patents, your copyright, your goodwill, and so on and so forth. We're really looking at the physical assets that we can value, and as you can see, this already is a book. It's a balance sheet, a calculation. 3 key things to understand here, as I've already said, it's determined by the company assets, real assets, fixtures, equipment, inventory, because these are the things that you want to value, you want to liquidate, you want to bring it to cash, liquidity, liquidate. You bring these values to cash as quick as possible and pay off your liabilities. The key thing is that this is usually lower than your book value, but can be, and in fact it is, created on a salvage value, and we'll talk briefly just about salvage value in the next slide. What is necessary to realize is that usually assets are sold at a loss during liquidation, because really at this point in time when you're liquidating, you really want to lay your hands to cash, and the seller wants to really get as much liquidity as possible in a shorter period as possible, so that they can pay off the liabilities or the creditors. And I mean, in practice, this will usually happen during an auction or things like that. I've said I'll touch on the salvage value. To really understand the salvage value, we're looking at the estimate of what the book value of assets are once you've accounted depreciation, or in fact when the assets have fully been depreciated, that is, they've lived or they've been utilized through their useful life, and this is what you're expecting to get from these assets when you're selling them. Let's say, for an example, you've got a vehicle that you bought at $1 million, and its salvage value might be around $50,000 because it has been depreciated over a period of 5 or 6 years, depending on what the depreciation model is. And as you can see here, the key word is the useful life. Usually a vehicle will be around about 5 or 6 years, and once that has been fully depreciated, what you can get if you're to sell that, that's what the salvage value is. Just to make a quick calculation to help you understand what this is, let's assume that you have liabilities of 550,000, and when you look at the balance sheet, your book value, not veil, book value is $1 million, and the salvage value of your assets in totality around about 50,000. So if we are to then sell the assets for this particular entity, let's assume through an auction, whatever the case may be, it's around about 750,000. Okay, so as I've said, the book value then will be your selling assets 750,000 divided by your liabilities, and that will give you 200,000. I hope you enjoyed the video. This is the liquidation value. If you want to connect with me, please click on the links below and stay on this video. It's Dr. Meiya. Have a beautiful day.